Andy, I was looking at your website and there's a box right on top, which is usually not there. And it says, due to unusually high demand, we experience delays in processing, shipping, and customer support response times. We appreciate your patience and apologize for any inconvenience. And the reason I'm bringing this up is not to have a go at you because I see a lot of other dealers with that same problem actually in the UK as well. The reason I want to talk about this is that the markets have come off in the last 10 days quite a lot, especially silver. And you'd think people wouldn't want to be buying gold and silver anymore. You know, they sold everything. So how do you explain that? What's going on?
We had record year last year. We did a third of the business we did all of last year in the month of January. The industry is on fire right now, Mario, and there are a lot of people, thanks to guys like you, who are aware and keenly aware of the forces that brought the paper price down, which are detached from reality in many respects. Yes, it certainly was something that affected the psyche of a lot of investors, especially new investors, but I think that the people who understand what is happening understand that this was a paper contrived smash, one that was at the heels of margin hikes that really went after the leverage players, which knocked the price down considerably. But you know, I think when you take a look, for example, at the March COMEX numbers, there's still almost 81,000 contracts of open interest open right now, which, you know, that I guess that sounds maybe that sounds abstract until you understand that there's 5,000 ounces of silver per contract. That's 402 million ounces of paper exposure tied to the March contract, where the first day of delivery is 2.5 weeks away. The big money, who doesn't play with margin, who's been standing for delivery every single month for the past 15 months, they're the benefactors. They're the ones who benefit from this smash down in the price of gold and silver, and the big money understands that. By the way, there's 402 million ounces of paper exposure tied to the contract, with only 103.5 million ounces in the registered category. What could possibly go wrong? Parallel to the same kind of conversation that you've had many times with the amazing David Jensen, who talks about a similar situation in London, 2 billion ounces of open contracts with 140 million ounces standing behind it, or something like that. Same thing we're seeing here on COMEX. This was a desperate act to get, I believe, some of these large players who are off sides in a big way, who were bleeding as the price kept going higher, maybe to get them to cover one last chance. It certainly wasn't normal market fundamentals. And, you know, when you see a price get hit that way and then in 2 days come back 35%, the volatility is extraordinary, but I will tell you that nothing changed. In fact, maybe only the fundamentals got stronger. And that's manifested into record demand. The interesting thing about the record demand, Mario, is that still is void of the majority of the mainstream public. It's just that the people who get it are doubling down and adding more and becoming more concerned about what's happening with the economy and the system. And it's just manifested itself as record volume throughout this entire industry. So it's not just the dealers like ourselves. It's the IRA custodians. It's the depositories. It's the shipping. It's everything is all but gummed up. And when you add record margin hikes into it, which keeps the refiners from taking any new business, in fact, stop taking any business, because understand that if they have $25 million worth of silver and gold that they are refining, and it takes time to refine it, break it down, refine it, and turn it into bars or whatnot, the amount of time that that's taking, in particular with silver, this whole way up, they've been getting margin called not only with the price of silver rising, but with the margin increases. So if they have 25 million in inventory that they are in working progress to make it, you know, from unrefined doré or junk silver or flatware or whatever that's being melted down, turned into shot, then turned into bars, that takes time. Well, the price of silver, they sell the exact same amount that they have that they paid for from the public on COMEX, so they're market neutral, right? Well, the prices had been going up so fast they were getting margin called, and then they raised the margin requirement so high that they're getting margin called, which is put them out of business type of environment. So they stopped taking any new business, and they are a huge source of revenue to the industry and liquidity. The liquidity's dried up in many respects, and it's just created a gummed up system where things are taking far longer than all of us are used to experiencing.
Yeah, and you mentioned the COMEX margin hikes, but they also like did trigger the
Circuit breakers.
yeah, they didn't.
Yeah, how'd that happen,
Yeah,
right? How'd that
twice,
yeah.
twice.
Well, it's just like when Jeffrey Epstein was in this maximum security federal prison, that the guards fell asleep and the cameras didn't work for once, right? So they just happened to fall asleep and the cameras just happened to not work. So we don't really know what happened. I mean, it's a lie. Everything is silly when you talk about the circuit breakers glitched twice, right? And allowed it to free fall. Well, at the same time, you look at JP Morgan covering 700 plus contracts at the exact bottom when this happened. Or if you take a look at the ETF, SLV, when the price fell, right at the time the price fell, and amazingly so, there was a jump in SLV's shares by 37 million shares. And so at 0.905 ounces per share, that's 33 million ounces of silver added in one day. Now, they added that at the very bottom. So in other words, the authorized participants create those shares like JP Morgan and Goldman Sachs, and they do so by delivering physical metal first. So think about what that means. Silver gets destroyed, and immediately after the smash, not only does JP Morgan cover 700 plus contracts, but tens of millions of ounces show up inside the ETF. And that tells you that, this was a forced liquidation and a margin event. And at the same time, they use that event to source physical cheap and inexpensively and park it inside the exchanges where they control it, inside the ETFs. And in my mind, this is forcing from weak hands to strong hands silver, from forced sellers to institutional vaults. And, I don't know. I think that when you line up the delivery pressure, the tightness in the registered inventories, the big stops that we've been seeing that are breaking, the circuit breakers, this isn't normal flow. This is inventory reshuffling under stress. And I think the most important thing to take away from that is that in periods of chaos and violence, markets do not reveal the truth. They only reveal the truth after. And price is the weapon or the misdirection, the tool of misdirection, and inventory is the confession. So yeah, they can use the price to freak everyone out, but the inventory on both LBMA and on COMEX are speaking a far more accurate truth. And that is that this is something that is going to get a lot more volatile, probably a lot uglier before it gets better, in the respect that the amount of entities that can possibly stand for delivery are way, way outpacing the amount of silver and gold that are inside the vaults. And I think ultimately you see much higher prices as a result of this imbalance.
Yeah, and even in China and Shanghai, the futures and the Shanghai Gold Exchange.
Yes.
Their inventories are falling like massively.
Yes,
So
they are, and that's happening everywhere as a result of the insiders that are understanding what the Western silly price is all about. And so they're not only are the inventories falling, but they're falling using the fake price that we have here in the West as a guide. Now they also have the arbitrage that we're seeing in Shanghai, where they are pricing the metal much higher in Shanghai by over like $30 higher than the West. And there's a lot of confusion on that. A lot of people will say, well, what about the tariffs or the VAT tax?
yeah, VAT, yeah.
But that's wrong, and I think people aren't understanding this, because the VAT tax is not the responsibility of the shipper, it is of the receiver, and only when the metal leaves Shanghai. So in other words, if JP Morgan delivers 50 million ounces of silver to Shanghai, they're getting the $30 per ounce spread. The receiver doesn't pay that tax until the metal is moved out of the Shanghai Metals Exchange. So it's not on the onus of the entity
Yeah.
shipping it.